Okay, in this video I'm going to give you an explanation of Goodwill, what it is, and how we record it, okay? First of all, you look up here. Goodwill is an intangible asset, doesn't have any substance. It is created only when one company purchases another, and it basically represents the additional value not captured by the existing assets of the company being purchased. So just to give you a very brief example, let's say a company has assets, net assets minus liabilities of $1 million, and another company buys them for $1.2 million. That company paid $200,000 over the net asset value of the company, right? So what's that $200,000? Why did this company pay an extra $200,000? That's the intangible asset that is being purchased. It has no substance, and it could be attributed to maybe the fact that the company has a very good reputation, good management. Their management is very well known. For example, if a company was purchased by, if the company had a manager like Elon Musk or something like that from Tesla, or Jeff Bezos, so maybe that company has some extra value that is not captured in their balance sheet, and so that company can't put that value in their balance sheet because there's no transaction that shows that value exists. So there's no reliability there, right? Anybody could say, hey, I have net assets of $1 million, but my company is worth 1.2 million. But there's no reliability in that information. However, when another company purchases that company for the $1.2 million, now there's reliability, right? Because you have a purchaser that was willing to pay extra. So in that case, you have a reliable transaction that attests to the fact that this company has some goodwill in it. In other words, it has an intangible asset in it that was not captured before by their books. So let's take a look at an example, and hopefully this example will help explain it a little bit better. This example is from the PowerPoint slides. Eddie Company pays $1 million to purchase all of James Company's assets and assume liabilities of $200,000. Okay? The acquired assets were appraised at a fair value of $900,000. What amount of goodwill, if any, should be recorded by Eddie Company? Okay, so Eddie Company paid $1 million for a company that has net asset value of $900,000. In other words, the acquired assets have an appraised value of $900,000, right? So it seems like Eddie overpaid for this company, but Eddie paid extra money because it wanted to, because it felt that James Company has that value. It may not be represented in their balance sheet, but James Company has that value. Okay, so it's willing to overpay versus what it sees on the balance sheet. So we start off with James Company's balance sheet here, and we take a look at it. As you can see, James' balance sheet has assets with book values of $855, liabilities of $200,000, which means that the equity is worth $655. Now, if this was the true value of James Company, that's what Eddie should pay for it, $655, right? So the first step that we're going to do is we're going to go ahead and translate these assets into fair value, okay? Eddie has the right to put these assets in its books when it transfers it at their fair value, not necessarily at the book value that James has it, okay? So Eddie hires an appraiser, and an appraiser takes a look at all these assets, and an appraiser gives Eddie the new fair values of those assets, the fair values of those assets, I should say, which are slightly different from the old book value that James had, okay? So the accounts receivable stayed at $30,000, inventory was appraised a little higher at $60,000, equipment stayed at $150,000, building was appraised a little higher at $310,000, and land was appraised at $350,000, okay? So the appraisal value of the assets turned out to be $900,000. That's the fair value that we see here, okay? So after the assets were appraised at fair value, we see that the company, James Company, which was purchased, had total assets at a fair value of $900,000 and liabilities at $200,000, which means that the equity is $700,000. That still leaves the purchase way too high, right? Eddy Company paid $1 million, and it was only able to identify $700,000 in net asset value. So if that's all it was able to identify, Eddy Company must have overpaid. Now that's very easy to calculate, right? Let's take a look at this here to show how we calculate this. Eddy Company paid $1 million, as it says here. The net fair value of the assets acquired is the fair value of the assets. Let me see if I have anything here that is the fair value of the assets minus its liabilities, which would be $700,000. So the net fair value of all the assets that James acquired were $700,000, not $1 million. So the goodwill is $300,000. That's the difference. Eddy must have paid an extra $300,000 for some asset that is not being captured over here in this balance sheet. What could that be? That could be anything. It could be the fact that James Company has a very good reputation, and that they feel, and that Eddy feels that that reputation is worth $300,000. It could be the fact that Eddy Company has such great brand name or great management, and so whatever it is, Eddy Company feels that James Company is worth $300,000 more than the net value it can identify on its current balance sheet. So they're willing to pay an extra $300,000, and that's what we call goodwill. So when Eddy Company purchases James Company, here's the transaction that they're going to do. Okay, Eddy Company is going to pay $1 million cash, right? So that's going to leave Eddy Company, and they're going to bring in all these assets at its fair value here, right? So those are going to cover these over here. It's also going to bring in the liabilities over here, which is the accounts payable and the long-term debt. That leaves this over here blank, right? So Eddy Company has a total of $1.2 million on the credit side and only $900,000 on the debit side. So the plug basically is the goodwill. It's the amount that was not identified in James' balance sheet. So we put goodwill $300,000. Okay, and now both sides balance. You have $1.2 million on the debit side, $1.2 million on the credit side, and the plug is goodwill. Goodwill represents some sort of value that Eddy Company saw in James Company that it could not identify based on the assets that it had here. Okay, if you want to do it very quickly without these transactions, without the entries, you simply say, well, how much did Eddy Company pay? Eddy Company paid $1 million. What's the net fair value of the assets acquired? That's the fair value of the assets minus the liabilities. The fair value of the assets was $900,000. The liabilities was $200,000. So they acquired a net fair value of $700,000, and they paid $1 million. Therefore, they overpaid, or they paid $300,000 for an intangible asset that's not captured by this book here, and we will call that goodwill. Okay, I hope this helped. Thanks.